I've heard a number of alarmist statements over the past few months. Here are some of them. India is too expensive, not a place to invest in. The Indian market has still got valuation multiples at 25 times, and foolish retail investors continue to lap it up because they've been convinced that SIPs will make them rich. If you're not investing in global markets, you're losing out. India's demographic dividend is finished. Mutual funds, and by extension retail investors, simply exist to provide an exit to foreign institutions. Depending on which phase of the market we're witnessing, you'll hear a number of narratives. In this case, of course, over the last few months, it's been negative, and so the narratives have matched that sentiment. But now, more than ever, these ideas get magnified very quickly because of social media. How much of this is true? And what should you do? Join me today on MoneyWise is Devina Mehra, who actually needs no introduction. And I say that because you're on this program as well. We've been looking forward to speaking to you. And you've shared this book with me, which I intend to read, Money, Myths and Mantras. So you wear various hats: investor, advisor, educator, author. So I'm going to ask you to don a few of those hats through this conversation, Devina. Let's start with maybe busting a few of those myths or busting a few of those narratives. India is not a market to be investing in for the long term. Is this correct?
What I find amazing is that both retail investors as the so-called experts, everybody drives looking backwards.
Yeah.
I had posted, I actually used AI to generate a caricature of somebody driving looking back. So because that's what people do. I mean, how many people told you in 2024 that India was an expensive market? Because India's PEs were definitely even much higher compared to the rest of the world then. And nobody even told you that consumption was slowing in 2024. I think I was the only person who was saying that in 23-24, India's consumption growth was at a 21-year low. But till the market was running, nobody pointed it out. Only end of the year when the market started to fall is when you started to see this logic. In January, you had investors putting in more in gold funds than in equity.
Yes.
Last year, March, April, the gold inflows were hugging the zero line. So everybody looks backwards. And actually, we did this, that if you systematically invest in whatever has done well in the last period, you will equally systematically underperform. So,
what time frame did you take?
I mean, we looked at 1 year and 6 months. And I mean, actually, 1 year was mostly what we worked on.
That's the tendency that people
Yes, and even funds. I mean, this was done by a fund house recently, that they looked at 5 categories of funds, large cap, flexi cap, small cap, etc., across 8 3-year periods and rolling. And they said that if you invested, let us say, if you invest in the top quartile, the top 25% of the funds in a particular category, in the next period, 80% of them would not be there. That's the statistic. Between 60 and 100% move out of the top 25% in the next period, an average of 80% plus. So that's what you're looking at. And also, I mean, global investing. I mean, I'm the one who's been propagating global investing for the last so many years. Yeah. I mean, First Global was the first Indian company to go global.
Sure.
And not just in investing, in financial services overall. I mean, RBI did not have a category for a subsidiary or overseas subsidiary for anything other than banks. This is back in 1999. So we became the members of London Stock Exchange in 1999. We were not just the first Indian, we were the first Asian members, ex-Japan. And the next year of NASD. So I have been propagating that you must globalize your portfolio because India is less than 5% of the world market cap. There's no reason 90% or 100% of your portfolio should be in India. But now it is a knee-jerk thing that last year India didn't do well. So now we have so-called global investment experts sort of sprouting everywhere.
Sure. But so
you have to be sensible. I mean, you have to be sensible. That's the whole point.
You have to be sensible. And the kernel of truth in this, which is ultimately the truth that will lead you to success in your portfolio as well, is that you cannot rush after or run after success. And you wrote about this in a column that you shared with me recently, which is the secret of success of Rakesh Jhunjhunwala. Why was he successful over the course of his career? And you write that it was not all of his ideas that worked. It was a few stocks that made
Very
him.
few.
It was very few stocks that made him money. You're talking about Titan, you're talking about Crystal, you're talking about
Lupin, and one or two others. That's
so,
it.
so therefore,
And
what
it's a
was his-
very similar pattern for Warren Buffett also.
So, but what is the secret here? What is the learning? If you look at Rakesh Jhunjhunwala, there are so many ideas that say that this is a man that was a maverick investor. He, of course, was ahead of his time, and he stood apart from the crowd. There are so many adjectives that adjectives that are used to describe, and he was great. He was great. Please don't get me wrong to say that I don't believe that he was great, but then. This is a man that he himself would say, look, there are periods when I have not made money. So what is the learning from Rakesh Jhunjhunwala?
See, one is the learning from Rakesh Jhunjhunwala, and there are places where I agree with him and places where I don't. But the part that I agree, and he was one who was 100% in equity, which is not something I recommend, and who made a lot of money, of course. But I think his superpower was not investing. I mean, every time you'd meet him at a party, he would be touting some stock with equal passion. And, so many of them went nowhere. But I think his basic thing was he understood how lumpy equity returns are. That equity markets are such where you will get a 10-year return in a 3-year period and get nothing for 7 years. So he said that's the part I have quoted. I mean, there was a whole book on him where they talked about his stock picking, all that. Yeah. And for me, there was only that one line that was a key takeaway where he says that I made money in spurts. I made money in 89 to 92, 2003 to 2007. 2003 to 7 is a period when the market went up sixfold,
yeah.
But after a 9-year zero return. So that's the part people forget. And then he talks about one more period, I think 2009 to 11 or something. And he said in between there were even 5 years where I didn't make money.
Sure.
But of course, my recommendation is that as an investor, never be 100% in equity. Not even if you are 25 and in a good job, because that's the sort of question I sometimes get, that I'm 25 and in a good job, should I be 100% in equity? No. You must have an asset allocation precisely because of this, that equity returns are not predictable. So equity should be money you don't need to touch for any reason whatsoever for at least 7-8 years. That's the thing. The second thing is that manage your risk well. Don't be on either end of the risk spectrum. Don't be in 100% safe assets like fixed assets, fixed deposit and PPF, and don't think you will become a day trader either. So, do a sensible asset allocation, then don't tinker around with it too much, and don't miss out on global diversification. And the caveat to global diversification is that the US is not the globe, which is the other thing. People think, one NASDAQ ETF or one S&P fund is enough. It is not. US is not the globe.
We'll get into some of these aspects, but I find what you said interesting about the periods of underperformance and the fact that there are periods of significant outperformance, but it can be followed by protracted periods of underperformance. And I think that the reason why we're dealing with so much pain and angst right now for the regular investor, Devina, is that they haven't experienced it.
A lot of them are new.
A lot of them are new. A lot of them climbed in after the COVID-19 crash, which was very, very short. And so this 2 years of underperformance of the Indian equity markets has been painful to the extent that they can't believe that they've gone through this. So therefore, what is the kind of message in that the tendency is to lose that gumption and to lose that disciplined nature. And a lot of people have kept their SIPs going. But equally, there are a lot of people who've cancelled and who've said, look, this is not for me. My SIPs have not made money. So what is the right path here?
The right path is to have the discipline. In fact, this is one of the areas which has interested me a lot in the last decade or so, which is not just the financial or investment analysis, but how many ways your own brain trips you up. How many, biases, randomness, how many things are there in your brain? Your brain is not set up to optimize your investment portfolio. It is set up for only two things, survival and procreation. And it might actively be working against your portfolio.
Give me some instances.
So that's the whole point. See, I mean, the time that you should at all think of booking profit or stopping the SIP is when things look very, very rosy. I mean, in middle of 2024, not just retail investors, I had family offices coming to me and saying, I don't have unrealistic expectations. I'll be happy with 30% compounding. I'm not making it up. It is.
And that must have been scaring you.
And I said, like, that is an unrealistic expectation because then it appeared that the money was there for the taking. Every stock you buy is doubling. So that time, no one wants to hear about risk management or being conservative. One of my RMs came and told me that people are saying, yes, we like listening to your ma'am, but she talks like Mother Teresa. This is not how it works. Launch a small cap scheme now. This is the time. So so actually, I mean, this is not my opinion. This is research studies show that sentiment is a contra-indicator. Oh. So the time when you are scared to be in the market is when you should be in the market, because then the next period returns are better than average on a probability terms. And it is when things are look too easy is when the next period returns are below normal. So that's why, I'm saying that a period up to September 2024, this excess buoyancy was there. And then you had a somewhat of zero return.
Sure.
And same thing you will see that, this is the reason, I never make index projections, not in January, not in Diwali. But this year I've been saying that in probability terms, 2026 should be a better year than 2025, simply because for the first time I'm seeing my fellows in the business talking about risk, enumerating risks. Otherwise, everybody was only selling quote-unquote India growth story. Well, the very fact people are talking.
So therefore, and this builds into to the point that you were making earlier about the percentile of funds that have outperformed, in that they've had their time in the sun. It's the probability of the next period being against them is higher than for those people that have actually been a little bit of a laggard.
Yeah.
The possibility that they will kickstart their leg. So don't rush after the gainers. Just build into this, because at this moment, a lot of people have actually gone through the last 3 months, right? And you've had at the index level as well pretty deep cracks. Of course, we've come back last week. But having said that, a lot of people did deploy in the first week and a half, 2 weeks. So whatever they had, Devina, because people said buy the dip, they actually went out and did that.
Right.
And then they don't have ammo. They don't have the dry powder to deploy any further. They're spent.
That's okay. They can stay on. It doesn't matter.
So
whether
it doesn't matter.
Yeah, you deploy more or you just stay on. That's all. I said don't tinker around with your asset allocation too much. On the other hand, I'm not saying buy the same stocks and hold. One of the big myths I've talked about here, buy and forget does not work. There is nothing like that.
Fill it, shut it, forget it.
It does not work. All the examples you hear that so-and-so's grandfather bought Hindustan Lever, or someone's father or mother bought whatever, HDFC Bank, and this is how much money they've made. These are all, you're talking the successes and you're forgetting the failures. Even, a narrow thing like banking, okay, HDFC Bank and Kotak gave those kind of quote compounding, but you've forgotten all the other banks that got licenses around the same time that
did nothing.
Yeah, did nothing means went bust. Global Trust Bank,
Sure.
the Times Bank, Centurion Bank, so many of the public sector banks. Yes Bank went through such a problem. So you forget all that. You look at the original Sensex list, and those were not fly-by-night companies. Those were companies with decades of
track
record. And look at the industries at that time. It was textile, paper, shipping. There were companies like Premier Automobiles, Hindustan Motors. There were all the JK Group and the Mafatlal Group,
Sure.
and everybody who's Thappers, who all passed into history. So that's how, those were the blue chips there. Make no mistake, they were the blue chips. Out of those 30 companies, only one had a relatively short track record, which was Indian Hotels. Every other company was around 40, 50, 70 years.
And so therefore, how many of the 50 stocks on the benchmark today could potentially not survive?
Yeah, not survive or become irrelevant.
Oh, sure.
Like, for example, when we started covering the US in the early 2000s, the tech majors meant Dell, Motorola, IBM, Cisco. People forget at one point was the highest market cap company in the whole world. So they're still around, but they are not the companies you think of as tech majors. The only tech major then, which is still a tech major, is Microsoft.
Sure.
That's it. The whole list has changed.
So the argument, for example, that people are making that IT companies in India are now, probably facing their last leg, is a relevant argument to make?
I think the obituary of IT services has been written too many times. I mean, starting from Y2K, that after that they won't have anything to do. The cloud came, the digitization came. I am not of that view. I mean, they may not be it's a macroeconomic question, because IT and related services were the direct and indirect driver of employment for the whole economy. I mean, that's the 25-year story of India is employment by this sector. And because of that, you have of course, you have the real estate and the retail and the driver.
In certain pockets, yeah.
Yeah, all of that. So it's a multiplier also of other people being employed. So I think they will be able to pivot this. That I have no doubt, because see, whatever AI does, no enterprise is going to hand over the keys to AI. There was a research paper recently called Agents of Chaos, that what happens if you allow the AI agents free rein. I mean, they've wiped out databases, they've wiped out systems, they've lied about it, they've been security breaches. So there will always be need for an intermediary even to manage the AI. So that's not going away. I mean, NASSCOM itself, even on employment, expects a J-curve that for some time there might be a little decline, and then and that's the history of technology over 300, 400 years. Every time a new technology comes, you say that this will, wipe out employment. Look at banking.
Sure.
I mean, I was a student, but I'm old enough to remember that all the banking strikes when computerization came in. And they said, like, this will take away employment because...
There was an RBI study that the deputy governor of the RBI quoted at a monetary policy that I attended, not the last one, the one before that. And she said that there are studies that suggest that employment actually gets a fillip.
Always.
When you have a disruption in technology.
Always. I mean, that's what I'm saying, that since the Industrial Revolution, that's the history. That every time any new technology comes, that, these many people will become unemployed, which, at the first order effect, it does happen. Automobiles come in, yes, everybody connected to the horse went out of business. But ultimately, it drove higher employment. This is true even of whatever spinning technology, weaving technology, that always, and today in banking, you have many more people employed than were employed before computerization.
Equally, Devina, I saw a meme the other day which said that the horse does not lose its job on account of the car. The horse loses its job if it doesn't learn how to drive. So there is an out. But having said that, you have such a keen focus on international markets, as you pointed out.
Right.
But equally in your argument, you've said that the best performers tend to underperform later. If we're talking about relative performance and valuations as things stand right now, and just the global landscape at this moment, you've seen the US markets perform a certain way, you've seen Japan, you've seen South Korea because of certain pockets, right? There is concentration in those markets as well.
Very much. Taiwan and Korea are extremely concentrated in markets.
And so therefore, if somebody's listening to this right now and listening to you to say global diversification is important, how should you incrementally do that? It doesn't make sense to go whole hog, right?
So, I mean, globally also the leadership changes. I mean, people think that US drives the whole the direction of the global market. People forget that after the 2000 crash, NASDAQ did not cross that high for 15 long years. It took till 2015 for it to meaningfully cross that. And in between, there was this period, 2003 to 2007, that we said in context of the Indian markets, that was actually a golden period for the entire emerging markets. The entire emerging market index went up 3.5, 4 times. Brazil went up 10 times. India went up 6 times. And US, which was not coming off a high, which was already in the doldrums post the tech crash, still hugely underperformed. That's when people said, the stories always follow. So, I mean, whatever is happening in the market. So that's when people said, oh, now the century of US is over. Now the baton has passed on. That's when BRICS was coined. Yeah. And then US started to outperform again. You forget the stories. Sure. So that's the history. So we don't think it is like a very easy thing that you can do an allocation one time in terms of the countries and let it be. So, and because this is a cause for me, I think Indians do not diversify globally. We actually have a product that invest across the globe,
Sure.
asset classes, starting at $10,000, which was 7.5 lakh rupees not very long back. Now it's 9 lakhs
but,
plus.
I get it. I get it. But having said that, even that product, okay, there are a lot of people today that are watching even this program, Devina, that will be able to access that. But let's face it, a lot of investors, a lot of retail investors in India do not have that capital or the ability to deploy that kind of money. So for those people, with a restriction that is in place in the mutual fund industry, to say that you can't.
I read somewhere of some Gift City product that
Yeah.
invests in a global index.
Sure.
So that might be the simplest thing if you can access that.
Yeah.
Otherwise, I mean, sending LRS money is very simple. It takes just a couple of days.
To set things up.
Yeah, it's not a very onerous task.
In terms of asset allocation, and you mentioned that 100% equity is not the way to go, right?
Not at all.
And for good reason. We've seen what gold has done. People, of course, have gone the other way to add 30-40% of gold to their portfolio.
Which is also not right.
To their detriment.
I mean, gold, this also people do not realize, because we are very, very data driven. So gold in dollar terms is a more volatile asset than equities. I mean, just in this whole gold boom, I'd seen a headline saying gold has not seen such a rally since 1979. I said, go forward from there. Now, what happened? So 1980, it made a high. Yeah. That high was not crossed till 2007. 27 years it took. And even nearly 2 decades after that, it was still down 60%. In 1999, the price was 60% lower than the 1980 price.
But what is the probability of that happening now? Considering...
No, the second high, it's not an aberration. That I said it crossed in 2007. It again made a high. From that high, it crossed, it fell 40%. So it's not that it was a one-time thing. That's the whole point. It is an extremely volatile asset. In rupee, it looks like a decent chart. And our grandmothers were not wrong in buying gold for two reasons. One main thing is that the rupee depreciates.
Correct.
And number two, earlier you could not invest in overseas markets. You could invest that this was the only asset you had to give you a currency hedge.
Sure.
So our Dadi Nani were right to buy gold because, but now you have a choice. Now gold is not the only asset you can. So, I mean, normally we in our multi-asset funds, whether it is India or global, we do have gold and silver, but both together, we've never crossed into double digits.
Fair point. And for the Indian retail investor, the average investor, from your lens, and this is not necessarily a one-size-fits-all solution.
Right.
What is the kind of exposure that is appropriate to international markets?
If you ask objectively, it should be very high. As I said, India is only 5%, not even 5%.
What is the
less than
definition
4%.
of very?
Huh?
What is the definition of very?
So I'm just telling you. So, I mean, I personally would have more than 80%, but I would say over a period of time, have 30-40% at least in your
equity portfolio.
Of your equity portfolio. Because that's, I mean, when I started working, the dollar was 12 rupees. So that gives you, when you are talking of long-term financial planning for goals which are 10, 20, 30 years hence for your retirement and so on, you cannot forget that this is how the rupee behaves. I mean, look at people now say that, okay, my child probably US is not such a good place to send children. Let me send them to Europe. Just in 2025, your bill went up 20%. The rupee depreciated against the euro 20% just in 2025. So that's what you're talking about. So, I mean, as I said, objectively, because you already have exposure to India, you have your house here, you have your career here. So it should be even proportionately less, but I'm saying at least get started.
And
so this came home to me. And why did we go global in 1999?
Yeah.
One main trigger was the Asian crisis of 97-98.
The currency crisis.
Yeah, currency and markets both fell. And between the two, all those markets in dollar terms fell between 50 and 90%. Taiwan fell 50%, Indonesia fell 90%, and South Korea, Philippines, Thailand were between this 50 and 90. And that was the kind of a wake-up call for me that this is the danger of being in a single market. And that's how, next year I went global. Because I said, this is not good enough. And I had spent a few months in Indonesia during my Citibank days, so it was very, close home. So I said, if I was an Indonesian, 90% net worth would have been wiped out in a year. This is not a sensible chance to take.
Yeah. So, okay, but tactically, and this is now we're drawing to the end of the conversation, Devina, and it's already been insightful, fascinating. Just bases the conversation we've had so far, and we're talking about a situation where people are not positive in India at this moment. And just from a sentimental standpoint, that should tell you that it might be a good idea to double down. Is that wrong?
Yes,
to
that's
think
what
that
I
way?
was saying. I mean, all research studies, and this I'm not just talking India and US, talking Portugal, Brazil, wherever this study has been done, it's the same conclusion that sentiment is a contra-indicator. So it's when the voice in your head is screaming, get out, is when you have to hunker down and stay in.
And this is that moment?
Yeah, and when everybody says that, sell everything else and put it into equities is when you should stop and think about it.
But in your opinion, is this that moment for India?
No, I'm not saying, as I said, I never make a one-year projection. That is something called objective ignorance, things which you not only don't know, but you cannot know. So in 30 years, I've never made an index projection. But as I said, in probability terms, this looks like it's probably a better time than we've had for a while, yeah.
Okay, and of course, with the caveat that you need to look far enough into the future. You shouldn't be expecting...
Yes, exactly. As I said, this is not a one-year projection. And also, it need not be the same stock. So one important thing, go right up to the last page of your DP statement. All the stuff you don't want to look at. As I said, many of us treat those stocks like our exes. We don't want to remember that we ever loved them. So grit your teeth and get rid of the garbage in your portfolio. Anything you will not buy today at today's price should not be there in your portfolio.
So great advice. And thank you so much for taking the time. It's been an absolute pleasure, Devina.
Thank you. Thank you for having me, Alex.